Hello, I'm Jonathan Moyes, Head of Investment Research at Wealth Club, and today I'm with Ed Pryor of SFC Capital to talk about their SEIS and EIS funds. Hello Ed, welcome to the studio. Firstly, could you give us a bit of background to yourself and SFC Capital?
Yes, of course. Thanks, Jonathan. Good to be here. So SFC, we've just celebrated our 10-year anniversary, actually. We originally started as an angel network. It was set up by Stephen Page, who's a software entrepreneur and is still our CEO today. But when the coalition government introduced the SEIS scheme, we quickly pivoted into SEIS funds, and we've now become the leading SEIS fund in the country. And we also operate award-winning EIS funds and have one of the largest angel networks in the country as well. Myself, so I joined SFC earlier this year to take over as Head of Investor Services. Before that, I was working across business and politics, so I've advised politicians on election campaigns and speech writing, and I've also worked with startups and founders on fundraising and published a couple of reports in the Times and Sunday Times on things like the future CEO and employee engagement and business transformation.
Interesting. And so the SEIS fund and EIS funds, what do they do for investors? What do they aim to do?
Sure. Well, ultimately, they're there to deliver strong returns for our investors. So we quite conservatively target 3x returns, 3 times returns on investments in our funds. We do this by building out very diverse and large portfolios. So we target highly innovative businesses across high growth sectors in the UK to build what becomes a diverse and very strong portfolio for each investor.
Mm-hmm. So Ed, if we start with the SEIS fund, what do you look for in an investee company?
Well, the first test that every investee company has to pass is their potential to deliver strong returns for our investors. At the earliest stages, which is where we operate at the seed stages, partly because the SEIS scheme, to qualify for the SEIS scheme, a company must be within 2 years of trading. Mm-hmm. Now, that may change next year. There have been proposals made, but nothing's confirmed on that. But that means you're investing at the earliest stages. So we target highly innovative businesses in future economy sectors. And at these early stages, what's critical is the team behind it. So it's as important as the idea. As businesses develop, business models often change, but people rarely do. So you can get a good gauge on whether this business has the capacity or the potential to do well based on those early conversations with founders. So we've actually developed a unique scoring system, which we take every business that we look at through. It's got 30 data points that we've honed over the last years of investing to judge each startup on their merits and their potential for our investors.
So SEIS funding then really is very early stage.
Yes, it does have to be because of the rules around SEIS. So there's 2-year rules making sure that a company is within 2 years of trading. Mm-hmm. Having said that, although we tend to be, or we see ourselves as first check equity investors, a great number of the businesses that we invest in have already been through various grant programs. So with Innovate UK and others, where they might have received tens or even hundreds of thousands of pounds.
So how do you source these investments?
So we look at about 3,500 businesses each year. And there are 4 key pillars to help us with that deal flow. The first one is that we have great connections and relationships with a number of universities such as Imperial, Oxford, Cambridge, and Sheffield as well is a brilliant innovation hub up there. And they're fantastic at providing us with excellent deal flow and really interesting founders. A second key pillar for us is our connection and relationships with a lot of incubators and accelerators across the entire country. That's a key part of our investment model, is looking at talent across the country, not just in London. Thirdly, we're lucky enough to have one of the largest angel networks in the country, and within that group are a number of strategic angels that are very helpful with introducing us to really exciting founders and really exciting new innovation-led businesses. And then the fourth pillar comes from the fact that we've invested in more than 350 businesses now as a fund. And those founders that we've invested in are all often a brilliant route into finding new founders.
And I guess as a brand, given that you've now invested in 350 SEIS companies, you are now a destination for entrepreneurs seeking SEIS funding.
Yeah, we really are. We've become quite synonymous with SEIS. As I said, we're the leading SEIS fund in the country, and we've won Best SEIS Fund Manager 3 years in a row now. So we have that name recognition in the market for both investors and founders. So a lot of the deal flow that comes our way is also organic.
So that's SEIS. And then if we move to EIS, how many companies are you looking to back?
Sure. So our SEIS fund and our EIS fund, they actually work in tandem. So our EIS fund is used to reinvest in portfolio stars. So we will build portfolios of between 5 and 10 businesses in your EIS portfolio as an investor. And really, when we're judging and making decisions on who to back within our SEIS portfolio, we have certain targets that each company needs to reach. And what's really great about this model is that we're able to watch these companies develop and grow for months and years before we make a decision on reinvestment. And that's the really only way you can get under the hood and really get to know a business in a much clearer way than if we were making that investment for the first time.
So Ed, what is the criteria for a company to move from that SEIS fund into the EIS fund?
Different criteria for different businesses because different businesses operate in very different ways. Some businesses, we expect them to have a lot of market traction. Other businesses, which are more research intensive, might not yet be at that stage. But what we really want to see is, before we commit to a round again, is either another lead investor in there or them having reached 50% of that funding target. So we want to see traction in place from others before we recommit.
Okay. And is the current environment changing the way you invest at all?
Macroeconomic trends are having an impact on every single market, some more than others. We are very focused on innovation-led businesses in areas like medtech and life science, which tend to be more resilient in these sorts of downturns. So no, we're not pivoting our investment model too much. One important thing to say is that we are doing more investments this year than we ever have done before. We are very confident about the early stage market, partly because these sorts of businesses that we're investing in, they are able to be more nimble, they're able to pivot, and they don't have that bloat. And so there is opportunities for new startups in downturns. And we've seen that happen time and time again with the likes of Airbnb and Twitter and Google. You know, these guys all arrived at the wrong moment, so to speak. But that's where innovation is really bred.
So Ed, could you tell us about some examples of recent investments you've made in the funds?
Sure. So we've actually made an investment yesterday in a business called Mimicrete, which is a really exciting business that has produced self-healing concrete. Now, this is a huge opportunity for the company. Across the European markets, we spend 40 to 50% of our infrastructure budgets on repairing repair works. Now, self-healing concrete technology will allow us to reduce those costs massively, but also reduce the carbon footprint attached to creating concrete because we do not need to have to create as much of it.
And is that a SEIS investment?
That is an SEIS investment. It's got a great founding team and we're really excited about it. Obviously, it's very early stage still, but they're well set up and we've got great hopes for them.
And what about some of the more mature investments within the portfolio? How are they performing? Any particular highlights?
Sure. I mean, so, as a portfolio matures, you expect the value to also increase. So if we look back at kind of portfolios from 2015, 2016, that fund is now it's about 7 times the value as when the portfolio was first created, and the year after, so 17, 18, that's now at 7.5 times the value of when it was first created. So kind of thinking back to my point earlier about our conservative 3x returns, we're kind of delivering consistently on them. Within those portfolios, those more mature portfolios, we've got great businesses in there. There's one fantastic business that springs to mind called Switch. Now, these guys create e-bikes, and what differentiates them from other e-bike manufacturers is that the actual production of the e-bikes can often be very carbon intensive. Now, these guys have really reduced that carbon footprint and are quite a game-changing opportunity for the market. So that investment we're still in, but it's at the last round. That was a 26 times 26 times increase from when we invested. Another company that I'm working with at the moment with our angel network is called Novi. Now, this is a company I'm particularly really excited about. They've created what's called dark technology, and that is what this technology does is early detection and prevention of eye disease, particularly for the elderly generation, in things like glaucoma. Now, that's a Series A point right now, and it's a 4 times value increase since our investment. But we expect a big kind of 18 months, 2 years ahead for that company.
Okay. So besides funding then, what do you do practically to help these companies succeed? Do you get involved with these companies at all?
Sure, yeah, in different ways actually. So we, when we make an investment, we receive a board seat on every company. This is really important in the early stages because we can help them implement good governance structures and really help with those early development stages of the business. We also have a very large partner network, which is able to help with specific needs of companies in finance or operations or marketing. And we also have this angel network, which is really important to early stage businesses because at that stage, a founder's role is very much about fundraising. And so if we're able to offer access to hundreds of angel investors as well as our funds, that's a real benefit for the startups.
Sure. And can you tell us about any recent exit activity within the funds?
Sure. So very recently, we exited a business called Vortex. Now they are air pollution monitoring systems. That was a 5x exit. We've also very recently exited another business called Cliff.ai, and that again was a 5x exit, and we actually have an earnout with that deal, which if achieved will end up being a 10x exit. And then actually relatively recently we exited on we part exited on a business called Cognism. So we've kept half of our shareholdings in that business, but we actually sold half for a 45x return, which if you include the tax efficiency, the tax benefits as well, actually ends up being closer to 100x return.
And so those are obviously some great return multiples. Investing at this stage is very risky.
Sure. In
a typical, let's say, an SEIS portfolio of, say, 20 companies, how many would you expect to fail?
Well, so Pareto's law, the 80-20 law of value applies to seed stage investing just as it does in other areas as well. So you're going to derive most of your value from just 20% of those businesses. So in a portfolio of 20 companies, you could expect 5, 6, 7 of them to actually fail. You might expect a couple more to just kind of meander but not seek an exit. And then you're looking at the rest for good returns and then very strong returns. So seed stage investing it's a game of home runs, not averages. You want to be giving yourself as an investor every opportunity you possibly can to deliver a home run for your investors.
Which I guess is why you have so many companies within each tranche.
Absolutely, yeah. And diversification is also critical for this. So we invest in every high growth sector in the UK. So if you were to invest in a SEIS fund, Jonathan, you would receive 20 companies, and you might have 10, 11 different verticals in there. And these are all high growth, high potential markets. So we're really looking at future economy businesses here.
So how much riskier is SEIS funding compared to, say, EIS?
It is definitely, it's more risky because these businesses tend to be earlier stage. And that's why you get more generous tax relief benefits as an investor in SEIS compared to EIS. Now, with our EIS fund, because we've got to know these businesses before recommitting, we're confident that they're going to be doing well. So the risk element does reduce slightly there. But even with EIS, there is always a risk. And investors should be aware of this as well.
Yeah. So to sum up then, Ed, I would like to invest in SEIS and EIS funds this year. Why should I consider investing in SFC's funds?
Why SFC? Well, I would just encourage you to look at the track record. We've been the market leaders for some time. We've consistently delivered above our target returns. We're the winners of the best SEIS fund for 3 years in a row. And we've got a model that works. That's been really kind of honed over years and years of experience.
Ed Pryor of SFC Capital, thank you very much.
Thanks, Jonathan.